Good morning. The hearing will come to order. Today, we will examine the lending environment for small businesses. Since small businesses create over 2/3 of new jobs, we must make an effort to ensure capital is available for their growth. By comparing pre- and post-recession levels of traditional small business lending, analyzing the factors affecting these levels, we can gain a better understanding of where we stand and narrow our focus on the policies that will spur economic growth and job creation. Recent data shows that banks are making more small loans in the past 2 years. Despite this improvement, loan levels are still below where they were before the recession. Economists, bankers, small business owners, and regulators point to different reasons to explain the post-recession drop in small business lending. Some suggest it is reduced demand by small borrowers, while others point to increasing regulatory scrutiny on banks. In reality, a confluence of forces has led to lower levels of lending. For instance, at the same time banks are being forced by regulators to require more from borrowers in the way of collateral and personal guarantees, home values, a huge source of collateral for borrowers, have dropped. And when the potential borrowers hear that it's hard to obtain bank financing, many do not seek it, thereby decreasing loan demand. We are fortunate to have with us a group of leaders within the small business financing space, from experts that analyze lending to those that are on the front lines making the loans. We will also hear from a business that offers a new source of financing that is becoming part of the lending environment. I look forward to learning firsthand what today's witnesses see as the factors shaping the lending landscape. With that, I would like to thank our distinguished panel of witnesses for being here today, and I now recognize the ranking member for her opening statement.
Good morning. Today's hearing will examine the current state of lending to small businesses. Although in the last 2 years the lending environment has slightly improved, bank loans to small businesses remain below pre-recession levels. Multiple factors and economic trends affect small business lending, and today we're going to receive testimony from experts and industry leaders on this very, very important matter. Evidence suggests that our nation's economy is slowly but surely on the mend. 7.8 million jobs have been created since the post-crisis low of 2010. The housing and auto industries, which were central to the downturn, have rebounded. The Federal Reserve's monetary policy stance has remained conducive, providing market liquidity and supporting a resurgent stock market. The small business sector is also experiencing an uptick in hiring. Still, expansion expectations are below the norms seen during the previous economic downturns. For job growth to accelerate and reach the pace that our economy needs, small businesses must become a bigger part of the equation. In every previous recession, it's been small, nimble firms that have led us back to prosperity by growing quickly and adding new workers. In order for these firms to play their traditional job-creating role, a number of factors must be in place. Perhaps the most important ingredient is the availability of capital. If, as the saying goes, small businesses are the economy's backbone, then the flow of capital is the lifeblood. Since the Great Recession, the value of small business loans remain at less than 80% of its pre-recession level. The number of loans issued also dropped from over 25 million before the recession to just over 21 million in the second quarter of this year. Although challenges remain, there's been progress. The Thomson Reuters PayNet Small Business Lending Index is well off its low, but remains below its highs. This indicates that firms are borrowing again, but are hesitant about the future. Few are also falling behind or defaulting on loans, suggesting they're in better shape to take on additional debt and hopefully expand. Within this context, it's important to remember that lending through the Small Business Administration is always critical for entrepreneurs seeking affordable capital. However, during periods of economic sluggishness, when credit is tight elsewhere, the SBA's role becomes more important. Last year, the agency made nearly $18 billion in 7A loans and made available another $5 billion in financing for projects under the 504 program. Unfortunately, while this represents a positive trend in the total dollars lent, the number of businesses receiving SBA loans has fallen dramatically. Compared to the agency's high water mark in 2007, when over 110,000 small businesses received loans, through this program, the total number helped has fallen by 51%, meaning that 56,000 fewer small businesses received loan assistance this year. And understanding what this trend means for entrepreneurs and what is driving it is of great concern to this subcommittee. All of this is occurring against a regulatory backdrop that's changing. Dodd-Frank resulted in a vast array of new regulations on the financial sector and established several new government entities. These new powers are necessary to address the root causes of the financial crisis, over-leverage and deceptive mortgages, to name a few. At the same time, we must be sure our nation's small banks and credit unions that were not the cause of the downturn are exempted. While regulations implemented under the Act will change many facets of the financial industry, data indicates that the perceived regulatory burden has had no negative effect on small business lending. In fact, a consortium of the nation's most prolific small business lenders recently announced they made an additional $17 billion in loans in the past 2 years. At today's hearing, we will take the pulse of the small business lending environment and gain insight about how to expand small businesses' financing options. And as we do so, it's important to remember that what makes sense for one entrepreneur might not work for another, and that there is a broad spectrum of capital options for small firms. Some businesses' needs can be met with conventional loans, and for others, a debt-based solution may not make sense at all. Equity investment might make a better fit. On that note, I'd like to thank our witnesses for taking time to be here. Their views and experiences will be very valuable to the subcommittee as we consider how best to meet small businesses' capital needs. Thank you, and I yield back.
Thank you, Mrs. Chu. The opening statement submitted, your opening statements will be submitted for the record. If any committee members have opening statements, theirs will be submitted for the record. I'd like to take a moment to explain the timing lights to you. You have lights in front of you. They'll start out as green. When they turn yellow, you have 1 minute. When they turn red, your time is up, but within reason, we'll give you a certain amount of flexibility to finish your statements. Our first witness is Anne Marie Wiersch, policy analyst at the Federal Reserve Bank of Cleveland. Mrs. Wiersch joined the bank in 1999 and worked in the accounting and financial management departments prior to her transition to a policy role in 2009. She has worked on several Federal Reserve System initiatives, including the projects focused on small business issues and state and local government finance. Mrs. Wiersch holds an undergraduate degree in business administration from Bowling Green State University and an MBA from Cleveland State University. Mrs. Wiersch, we look forward to your testimony.
Chairman Rice, Ranking Member Chu, and distinguished members of the subcommittee, it is an honor to testify before you today on the state of small business lending. My statement will focus on the decline in lending to small businesses and the factors that are driving that decline. My remarks represent my own views and are not official views of the Federal Reserve Bank of Cleveland or any other element of the Federal Reserve System. Recent industry and media reports provide a mix of perspectives on the state of small business lending. Contradictory messages abound and often result from inconsistent definitions of what constitutes a small business and from the absence of comprehensive and reliable data on small business lending. Banks and government agencies use a wide range of parameters to classify firms as small businesses. One frequently cited definition is so expansive that it includes more than 99% of businesses in the U.S. It should not come as a surprise, then, that we hear so many differing reports about small business conditions when firms of so many different sizes and industries are analyzed together. In addition, the considerable lack of data on small business lending and the variance in the size of firms and loans included leads to inconsistency in reporting among the data that are available. Nonetheless, we do know that bank lending to small businesses declined since the onset of the Great Recession. According to FDIC data, the current value of small loans outstanding is about 78% of its pre-recession level in inflation-adjusted terms. Recent analysis by the Federal Reserve Bank of Cleveland concludes that there are a number of factors driving this trend. Fewer small businesses are interested in borrowing than in past years. And at the same time, small business financials and collateral values remain weak, depressing loan approval rates. Furthermore, increased scrutiny from regulators led some banks to boost their lending standards, resulting in a smaller fraction of creditworthy borrowers. Finally, shifts within the banking industry have reduced the number of banks focused on the small business sector. Small business lending has become relatively less profitable than other types of lending, dampening some bankers' interest in this market. Small businesses were hit hard by the economic downturn, and weak earnings and sales mean that fewer businesses are looking to expand. Surveys show that since 2007, fewer businesses plan to seek credit, increase capital investment, and hire additional workers. Some of this subdued demand for loans may stem from perceptions that credit is not readily available. According to recent surveys, more business owners think that credit has become harder to get and will remain so. The supply of credit has also declined, as lenders are approving fewer small business loan applications, with many firms lacking the cash flow, credit scores, and collateral that banks require. More lending is secured by collateral now than before the recession, and the decline in value of both commercial and residential properties has made it difficult for businesses to meet collateral requirements. At the same time, bankers have increased their credit standards, meaning that fewer small businesses qualify for loans than before the economic downturn. Banks tightened lending standards significantly during the recession, and while standards have eased somewhat in recent quarters, data show they remain stricter for small businesses than for large firms. Furthermore, there is evidence that heightened scrutiny by regulators factored into banks' decisions to tighten standards. Research shows that elevated levels of supervisory stringency have a material impact on total loans and loan capacity. The decline in lending also reflects longer-term trends. Banks have been exiting the small business loan market for over a decade, leading to a reduction in the share of small business loans in banks' portfolios. The FDIC reports that the fraction of non-farm, non-residential loans of less than $1 million has declined steadily since 1998, dropping from 51% to 29%. Consolidation of the banking industry has reduced the number of small banks, which are more likely to lend to small businesses. Moreover, increased competition in the banking sector has led some bankers to seek bigger, more profitable loans. The result has been a decline in small business loans, which are less profitable because they are banker time intensive, are more difficult to automate and securitize, and have higher costs to underwrite and service. While the decline in small business credit since the Great Recession is evident, the causes of the decline are less clear. A careful analysis of various data sources suggests that a multitude of factors explain the reduction in credit. The supply and demand forces unleashed by the financial crisis added to longer-term trends, as some banks had already been shifting away from the small business credit market. The confluence of factors makes it unlikely that small business credit will spontaneously increase anytime soon. Given the contribution that small businesses make to employment and economic activity, policymakers may be inclined to intervene to promote greater access to credit for small business owners. When considering means of intervention, however, it is important to be cognizant that multiple factors are affecting credit demand and supply. Any proposed solution should consider the combined effect of all the factors involved. This concludes my prepared remarks, and I look forward to your questions.
Thank you, ma'am. Our next witness is Jeff Stibel, Chairman, Chief Executive Officer, and President of Dun & Bradstreet Credibility Corporation. Mr. Stibel was previously President and CEO of Web.com, Inc., and currently sits on the boards of numerous private and public companies, as well as academic boards of Tufts University and Brown University. He is the author of academic and business articles, the book Wired for Thought, and is the named inventor of the U.S. Patent for Search Engine Interfaces. Additionally, he was the recipient of the Brain and Behavior Fellowship while studying for his Ph.D. at Brown University. Mr. Stibel, we look forward to your testimony.
Thank you, Chairman Rice, Ranking Member Chu, the committee, and its wonderful staff for having me here today to discuss what I believe is one of the most important topics in regards to the economy today. As you mentioned, Chairman Rice, I'm the CEO of Dun & Bradstreet Credibility Corp. We're one of the largest business credit monitoring companies in the United States. So I believe I have a unique perspective into the topic of small business lending. My written testimony is full of statistics that demonstrate, in short, that small businesses today are finally doing well again. Yet, despite that fact, they're not adding jobs. The reason is because they need access to capital to grow their businesses, yet they're not able to secure sufficient loans. It's a small business paradox, one in which small businesses are growing revenues, but not payroll, and that's hurting our economy and society as a whole. what we're seeing in effect is the smaller the business, the greater the revenue growth. And we're seeing this throughout this year. This is a good thing. It also means that the smaller the business, the greater the productivity, as measured in terms of revenue output per employee. However, what we're not seeing is that the smaller businesses are adding jobs. And it's the jobs that really drive our economy forward in the long run. Rather than regurgitate these statistics, I'd like to tell a story about a small business owner that I met only a few days ago. I believe his story, better than any statistics, will encapsulate the problems that we're facing. I met Mike Bansfield on Monday of this week. He founded SpringStar in 1998 in Seattle, Washington, to offer organic pest control products. It was a huge success story almost right from the beginning. He grew revenues, he grew employees, he eventually got a bank loan, and that fueled his growth even further. Throughout the recession, Mike's business actually thrived, and he continued to grow. However, as we've all seen, banks didn't fare as well. So the bank ended up calling his loan. Despite the fact that this was an SBA-backed loan, Mike had to give a personal guarantee because that's still required. And when he pulled that loan, Mike's successful business went under, and he almost went bankrupt himself, ruining his family. The good news is that Mike's an entrepreneur, and he persevered. And he ended up finding an alternative source of capital, rebuilt his business, was able to grow that business, and that business is now thriving today with record revenues. However, he hasn't added any jobs. To add jobs, he needs greater access to capital. The problem is that Mike has been trying for years and can't get a bank loan. Now, he's just plain discouraged. He needs a loan, but no longer wants a loan. A little-known fact in business is that jobs are added for future growth, not current demand. For current demand, people in business just work harder. Job growth is an investment, just like computers, equipment, tools, manufacturing. Investments require capital, but many companies like Mike's aren't willing or able to secure loans anymore. And the stats are frankly alarming. The smallest businesses have less access to capital, and the smallest business owners have less desire for that capital. We have a small business paradox, and there's an even greater need than there ever has before. This, personally, is a painful story to hear as a business person. A company poised for success that just needs access to capital. I suspect it's a painful story to hear for government. A company poised to impact the economy and society, but can't unless it gets access to capital. But most of all, this is a painful story to hear for the unemployed. We have people who desire to contribute to society, who see a desperate need from a company, but a need and desire that cannot be fulfilled without access to capital. I believe that's why we're all here today, and working together, business, banks, and the government, we can all work to make a difference. So thank you.
Thank you, Mr. Stibel. Our next witness is Renaud Lap, founder and CEO of Lending Club. Prior to starting Lending Club in 2006, Mr. Lap was the founder and CEO of Triple Hop Technologies, an enterprise software company eventually acquired by Oracle. He was named the 2013 Ernst & Young Entrepreneur of the Year award winner for Northern California and 2012 Entrepreneur of the Year at the BFM Awards. Mr. Laplanche has a Master's of Business Administration from HEC and London Business School and a JD from Montpellier University and is a frequent guest lecturer at Columbia Business School. Mr. Laplanche, we look forward to your testimony.
Thank you. Good morning. Thank you for having me. My name is Renaud Lap, and I'm the founder and CEO of Lending Club, a credit platform that employs over 300 people in San Francisco and has facilitated over $2 billion in consumer loans this year, funded by both individual and institutional investors, and we'll be launching a dedicated small business lending platform in the next quarter. My father was a small business owner. He owned a grocery store in a small town in France, and I spent every day of my teenage years from 5 to 8 in the morning before class helping him in the store. After having started 2 companies in New York and San Francisco, residing in the US for over 14 years, and starting a family here, I recently passed my citizenship test and will soon be a U.S. citizen. Testifying before this committee on the state of small business lending in America is a very special moment for me. Small businesses are not only a driving force in the U.S. economy, they are an essential part of the American dream. I believe it is our shared responsibility to ensure that these businesses and their owners have sufficient access to capital on fair terms. I have 2 points I hope to convey to you today. First, small businesses have insufficient access to credit, and the situation is not getting any better. Second, their credit performance as a group suggests that they should be getting more credit. A survey released by the Federal Reserve Bank of New York in August of this year was the latest to paint a grim picture of availability of credit to small businesses. Access to capital was reported as by far the biggest barrier to growth. Out of every 100 small businesses, 70 wanted financing. Of those 70, 29 were too discouraged to even apply. Of the 41 that did apply for credit, only 5 received the amount they wanted. Substantially, all of these businesses were looking for $1 million or less in capital. Situation has not gotten any better lately. While the overall volume of loans of more than $1 million has risen slightly since 2008, loans of less than $1 million have fallen by 19%. The number of small businesses with a business loan fell by 33% from 2008 to 2011. The problem is worse for the smallest businesses. While businesses with 20-plus employees reported an increase in bank loans from 2009 to 2011, the majority of small businesses, which have fewer than 20 employees, reported a decline, with the smallest businesses suffering the steepest decline. Businesses with 2 to 4 employees reported a 46% reduction in bank loans over that same period. While traditional sources of capital have pulled back, alternatives are on the rise. Alternative lenders, such as online lenders and merchant cash advance providers, are the fastest growing segment of the SMB loan market, reporting a 64% growth in originations over the last 4 years. Many of these alternative lenders, however, charge fees and rates that result in annual percentage rates generally in excess of 40%. And without always full transparency, business owners don't always understand the true cost of these loans. This lack of understanding can be very harmful to small businesses, which could find themselves in a spiral of inescapable debt service. Small business credit performance and loan performance, however, is doing just fine. Charge-off rates on small business loans have been below 1% since March 2012, down from a peak of nearly 3% in 2009. In contrast, charge-off rates on consumer credit cards peaked above 10% in the financial crisis. These figures show that absolute loan performance is not the main issue of declining SMB loan issuance. We believe a larger part of the issue lies in high underwriting costs and generally high operating costs for the lenders. SMBs are a very heterogeneous group, and therefore the underwriting and processing of these loans is not as cost efficient as underwriting consumers, a more homogeneous group. Business loan underwriting requires an understanding of the business plan and financials and interviews with management that result in higher underwriting costs, which make smaller loans under $1 million and especially under $250,000 less attractive to lenders. By contrast, larger loans, going mostly to larger businesses, are more attractive as they allow for underwriting costs to be amortized over a larger amount and longer loan period. We believe we have solutions to bring underwriting costs down and create the conditions for credit to become more available and more affordable to small businesses in America. And we would be honored to answer the subcommittee questions in that regard.
Thank you, Mr. LaPlanche. Our next witness is Fred Green III, President and CEO of the South Carolina Bankers Association, based in Columbia, South Carolina. Prior to his current position, Mr. Green served as President and COO of Synovus Financial Corp., a 5-state bank holding company, and before this, as President, CEO, and Chairman of the National Bank of South Carolina. Mr. Green also previously served on the board of 5th District Federal Reserve Bank based based in Richmond, Virginia, and on the Federal Advisory Council for both the 5th and 6th districts. He received his BS and MBA from the University of South Carolina. Go Gamecocks. Mr. Green, we look forward to your testimony.
Chairman Rice, Ranking Member Chu, members of the committee, my name is Fred Green. I'm President and CEO of the South Carolina Bankers Association. We're the professional trade association that has represented South Carolina banks for over 110 years. Our members are both large and small banks, and collectively they hold about 99% of the deposit market share in our state. I've been a banker for 34 years, mostly in leadership roles in commercial banks, and for the last 2 years I've headed up our state association. This morning I'm pleased to share the banking industry's perspective on the state of the small business lending environment. You all know how important small business is to the national economy. Small businesses account for over half the jobs in the U.S. and as much as 65% of new jobs created over the last 15 years. Banks are the primary lenders to small businesses, and their presence in local communities throughout our nation is critical to meeting the unique needs of new and developing companies. There's a symbiotic relationship between the health of a community and the health of the banks that are located and operate there. It's why small business lending is an important part of every bank strategy, and why banks today provide more than 21 million small business loans. Loan demand has improved since the recession. However, it remains at relatively weak levels, held back, I think, and we all think, by uncertainty about the future. Concerns over changes to taxes, employment costs, and regulation make small business owners less interested in expanding and incurring new debt to fund that expansion. Another point that reinforces the lower demand is the utilization of borrowings under existing committed lines is at a relatively low level at 50%. These are loans that have already been committed. The borrower can draw down to expand, but have only drawn up to 50%. Despite the low loan demand, banks continue to meet the needs of their customers. At every community, banks are actively lending and continually looking for lending opportunities. After declines in the loan portfolio since pre-recession peaks, recent FDIC data shows that outstanding loans have been growing over the last 12 months. Banks face challenges in providing loans to meet their customers' needs with the most recent wave of regulations as well. The cumulative impact of hundreds of new or revised regulations may be a weight too great for many small banks to bear. Congress must be vigilant in its oversight in implementing the Dodd-Frank Act to ensure that rules are adopted only if they result in a benefit that clearly outweighs the burden. Some rules under Dodd-Frank, if done improperly, will literally drive some banks out of business. In South Carolina, we recognize this growing concern and recently held a special conference of our top bank executives to address significantly stricter mortgage regulations and capital standards that will be implemented next year. Some community banks have already told us that they will have to stop offering certain products like residential mortgages because of the new lending regulations. For many, these community banks are the only option in their community, the only source of lending of this type in their community. In fact, community banks are the only physical banking presence in 1/5 of the counties in the United States, and more regulation means more resources devoted to regulatory compliance, and this means fewer resources can be dedicated to doing what banks do best, and that's meeting the credit needs of the local communities, the businesses, and the residents that are there. Banks are eager to serve the financing needs of small businesses. They understand that they play a critical role in their local economies, and no bank has or wants to stop pursuing small business lending. Yet small businesses remain hesitant to expand due to the economic uncertainty. This does not mean that banks are not making loans. Our economy is growing, although slowly, and banks are addressing the financing needs that exist today. Healthy Properly financed small businesses are absolutely critical to our community's economies. Banks understand their role in this and continue to make loans to every credit-worthy borrower they can, despite an increasingly difficult lending environment. Thank you again for the opportunity to testify.
Thank you, Mr. Green. I would now yield to Mrs. Chu, who will introduce our final witness.
I have the pleasure of introducing B. John Pharmakides, President and CEO of Lafayette Federal Credit Union. Mr. Pharmakides is the President and CEO of this credit union. He's been an active member of this particular credit union community since 1994 and was named President and CEO in 2007. Prior to that, he worked in investment banking, commercial real estate, and for the federal government. Currently, Mr. Pharmakides holds positions on many professional boards and serves on the regulatory committee of the National Association of Federal Credit Unions. Mr. Pharmakides received his BBA and MBA degrees from James Madison University and a law degree from the American University. Welcome, Mr. Pharmakides.
Thank you. Good morning, Chairman Rice, Ranking Member Chu, and members of the subcommittee. My name is John Pharmakides, and I'm testifying today on behalf of the National Association of Federal Credit Unions. I serve as President and CEO of Lafayette Federal Credit Union, headquartered in Kensington, Maryland. NAFCU and the entire credit union community appreciate the opportunity to discuss the small business lending environment. Credit unions serve over 97 million people from all walks of life, and we are eager to provide our members the best lending opportunities while helping to spur job creation. Despite regulatory and statutory obstacles to credit union business lending, a November 2013 survey of NAFCU members found that credit union member business lending is growing over the next 12 months. On a scale that goes from negative 100 to positive 100, where 0 indicates flat growth, the median growth expectation for credit unions was 35.6. Still, credit unions are hampered in their ability to help small businesses by an arbitrary and outdated member business lending cap that hasn't been adjusted in over 15 years. Credit union member business lending is limited at 12.25% of total assets, with member business loans over $50,000 counting against the cap. This is counterproductive as the country continues to recover from the financial crisis. At Lafayette, we have seen increased demand from our members to access business lines of credit to help meet day-to-day cash flow shortfalls and manage the needs of their businesses. I have example after example of ways we have been able to help, such as a $125,000 line of credit we extended to a local bike rental and touring company to help manage the cyclical nature of their business. Unfortunately, any line of credit above the $50,000 threshold counts towards the cap, even if the funds are not actually extended. Consequently, Lafayette is forced to pick and choose which business loans will be funded, even though all are creditworthy. Businesses often turn to us when they have denied lines of credit from other lenders. So if we can't extend the line of credit, it is likely to happen it's not unlikely to happen anywhere else. I'm very proud of my staff and the level of expertise we have in member business lending. Just in the last year, we have been able to assist very small traditional companies, such as a specialty bakery with a single owner. At the same time, we have made loans to several consulting firms related to government contracting, in addition to a trucking delivery service, as well as an innovative solar energy appliance company. We urge members of the subcommittee to help credit unions by supporting corrective legislation to modernize the cap, such as a bipartisan bill introduced by Representative Ed Royce and Carolyn McCarthy, H.R. 688, along with the ideas to assist small businesses, such as adjusting the outdated definition of a member business loan from $50,000 to a new 21st century number of $250,000 indexed for inflation. The Small Business Administration loan programs also are an important resource that help credit unions provide capital. However, utilizing an SBA loan guarantee program requires meeting stringent government regulations. We are an approved SBA 7A lender, but currently have just one SBA 504 loan outstanding and one USDA business and industry loan outstanding. Part of the challenge for credit unions is determining the overall applicant eligibility to participate in an SBA program, which is nearly as important as determining the applicant's creditworthiness. Failing to meet certain eligibility criteria may preclude the applicant from participating in an SBA guaranteed loan program. Eligibility criteria includes, among other things, size restrictions, type of business, use of proceeds, credit standards, and meeting a credit elsewhere test. If Congress and the SBA were to make it easier for credit unions to participate in these programs, small businesses throughout the nation will have greater access to capital at a time when it is needed most. A 2011 SBA study found that credit unions played an important countercyclical role to meet demands of small business loans while others pulled back during the recent recession. In conclusion, small businesses are the driving force of our economy. Credit unions play an important role in helping our member small businesses access the funds they need. Congress should do everything they can to ensure credit unions can meet the needs of their members. Thank you for the opportunity to testify today, and I welcome any questions you may have.
Thank you, Mr. Pharmakides. I am going to withhold my questions until the end and work with the panel here. Mrs. Chu, would you like to do the same? You can, whichever order you prefer is fine with me.
Yes, well, you know what? Well, I would like to defer to the member as well and
Okay.
give him a first shot.
I'm going to start with Mr. Mulvaney then. Thank you.
Thank you, Mr. Chairman. Folks, thanks very much for participating today and listening to your testimony. I harken back to a story that I heard when I was in Charleston, South Carolina, a couple of months ago, meeting with one of the small community banks there, and they were telling me about the last visit they had from their examiner. And the examiner at the end of the process asked them how they were dealing with Dodd-Frank. And the bank president said, well, it's absolutely killing us. The additional paperwork has required us to hire 3 new people to do nothing but fill out the new oversight paperwork. And the examiner's response was, well, then it's working because you've created 3 jobs. I think we could leave for another day the discussion as whether or not that's really jobs created or jobs simply shifted from one part of the economy to another. But it reminds me of something that Mr. Green spoke to, which is the impact of Dodd-Frank on capital available for lending. It strikes me that if I have to hire 3 people to fill out paperwork, that takes money away from what I can lend out to my customers and so forth. Mr. Green, walk me through just a couple examples you think of how Dodd-Frank is impacting the capital available for small business lending.
Well, Congressman, first off, the example you gave is what we hear from all of our bankers throughout the state, and I would think many of our counterparts throughout the country. There is a shift of resources away from customer contact bankers, those that might be out looking for loans and making loans, now to the compliance side. The banking industry, bankers by definition, are risk adverse. They have to understand the risk. They have to put in policies and procedures to manage that risk. And with the mountain of regulations that have come and been thrown on the banking industry, and not only the volume but the velocity, the quickness in which it's come in, the proposed regulations that will soon follow, the banks have had to go out and hire lawyers, consultants, compliance folks, as you indicated, and those are resources that had heretofore been out meeting the needs of the borrowing constituents around in the community. That's one example. The other example would be documentation, and that's a big one because lending is both an art and a science. When I started in the banking business, we called it the C's of credit. The science part of the C's of credit are cash flow, capacity, collateral, things like that. The primary part of the C's of credit were characters. In the larger loan opportunities, the quality of the financial information is much stronger than it is in the smaller borrowing entities, the smaller companies. The quality of their financial information is not as robust. They don't have as much information. They can't predict the future maybe as well based on trends. So the tipping point between whether many loans are made in that smaller category falls to character, and that's knowing the customer, knowing the community, knowing the competitors, and the ability to maybe take that risk. Now, under Dodd-Frank and under regulations, you have to document every loan opportunity. The problem there is you can't document the intangibles like I just described. As a result, we've had many bankers come to us and say, we would have made this loan many times in the past. In fact, made many loans like this in the past, and are good customers today. But we can't make that loan today because we can't document this intangible piece that is so important. So as a result, there are, we think, a lot of loans, primarily in that smaller category, that aren't being made as a result of the regulation.
I also get the impression that the compliance requirements are driving some consolidation. There's a great deal of consolidation in the industry, but some of it's being driven by compliance requirements because the smaller institutions simply don't have the infrastructure necessary to meet the compliance requirements. And it strikes me that's also limiting availability of capital to small business. Would you agree with that?
I agree. Yes, sir. If you think of it this way, compliance cost is a fixed cost. The larger the institution, that cost is spread over a larger asset base and larger earnings base. The smaller the institution, that's a heavier burden. Regulation applies to all banks regardless of size. So the smaller the institution has to dedicate more resources, more cost, and has a smaller base to spread it over. So therefore, their earnings capacity is less. Earnings capacity is less. The future is maybe uncertain. Consolidation has occurred and will continue to occur. I've talked to a number of investment bankers who've told me that there's a tremendous amount of conversation going on now with smaller community banks, and a lot has to do with this increased cost structure as a result of it.
And there was something that Mr. LaPlanche said, I'm not going to get a chance to ask questions, maybe we'll get a second round later on, that said that because of that, the character, the intangible nature of small businesses, that it's a higher cost to lend a small business, it's harder to do, and if we don't have these community-based institutions, the larger institutions simply aren't going to take on that lending possibility. But I'll maybe get a chance to ask that question later on. Thank you, Mr. Chairman.
Thank you, Mr. Mulvaney. Mr. Payne?
Thank you, Mr. Chairman, and to the ranking member. Let's see, Mr. LaPlanche, you in your written testimony proclaiming to have solutions to bring underwriting costs down and create conditions to increase credit availability and affordability. Please share some of those ideas with the committee.
Yes, thank you for giving me this opportunity. So first, I want to start by saying that nothing will ever get better, no underwriting process will ever get better than the relationship between a community banker and a small business owner. That's always going to be the best way to combine with financial information and credit data, the best way to assess a small business owner's ability to repay the loan and make the business successful. I think the solutions we're working on are not designed to be a substitute. They're really designed to fill in a void. So in the absence of that tight relationship, or in circumstances where these relationships do not lead to a successful loan application, we believe we can offer tools that help make these loans possible and at a low underwriting cost. And part of the answer here is technology. And we believe that technology can be applied in two different ways. One, to sort of aggregate financial data and make that financial data more readily available to loan underwriters. And two, by looking into new non-traditional underwriting data sources. So in the first category, we're working with a number of data providers to help pool data about the small businesses that apply for a loan with the express consent of the small business owner. For example, we're working with Intuit Corporation, the maker of QuickBooks, so through an API call, so for a technology solution, essentially collect all the QuickBooks data, so the entire accounting of the small business, and extract that information, run analysis on that information, calculate ratios that can be used as part of the underwriting and can be reviewed by the underwriter. And that data extraction, the data analysis process can make the job of the underwriter easier and can also lower the burden for the business owner to collect that data and transfer that data to the underwriter. Okay. So that's one category. The other category is incorporating in the decision, in the pricing decision or the underwriting decision, data sources that are available online now through the internet and can be used as a proxy of business reputation and future business performance. There are sort of rating and customer satisfaction websites like Yelp or OpenTable or Angie's List that collect, that give the opportunity to customers to rank small businesses and give feedback on the experience they had with the business. Our ability to collect that data, analyze that data, and use that data as an additional source for underwriting can be extremely useful, can be done in a way that's highly automated, low cost, and provide some insight as a complement to other more traditional sources, provide some insight into future business performance.
Okay, thank you. In the interest of time, I'll yield back so we can possibly get to a second round. Thank you.
Mr. Schweikert?
Thank you, Mr. Chairman. And forgive me if this one becomes a little ethereal, but on particularly truly small businesses, you know, the one with under 25 employees that comes into an institution, and I don't know if this might be from a regulator's standpoint. If it were a decade ago, and I'm coming in for working capital, do you feel, for those of you on the lending side, you had more flexibility? Okay, you have a couple trucks that you have equity in, all right, well, we know you own your home. And are the regulators not allowing you to look at their full asset bundle? And do you get punished if you've done that look at the asset bundle when you have your auditing mechanics? Mr. Green.
Congressman, let me start with that. I do think the flexibility has been significantly reduced. I mentioned the regulatory scrutiny and documentation. You know, a lot of times the primary asset of a small business owner is their home and equity in their home. To be able to take that equity now as collateral requires a whole lot more cost, a whole lot more scrutiny, a lot more documentation than it would have before. And the same goes for other type assets. So, yes, sir, it absolutely has changed.
Well, in that same look on co-signers for debt, I don't know how many people in the room at some time in their life have had a family member wanted to start a business, and we were all really, really stupid or very, very loving, whatever you want to consider, and helping co-sign, you know, them to get some of their debt instruments to start their business. And my understanding is that also is one of the things I will see dramatically less of as being an acceptable collateral mechanic today. I mean, is what I'm being told your experiences?
Yes, sir. I'll just add one more comment, then let my other panelists talk about it. That is important because I mentioned earlier about character sometimes being the tipping point. A lot of those guarantors are family members, and having a family member on there, father, mother, that would guarantee it. A lot of times they were tougher on that borrower maybe than the lender would be because of that.
Well, it just makes Thanksgiving really uncomfortable when you
yes,
have problems. But in this, and forgive me, is it Weirich? Wirsch. Now, you actually, with your position, you actually touch probably a lot of accumulated data. Are you seeing something in the data that's sort of outside the folklore we're having this discussion of, you know, why is it those small businesses aren't walking into their credit unions or their community bank to even ask for a loan? I mean, what do you see really going on in the data?
Really, I think it is the combination of factors. Demand is definitely part of the issue, and you know, in terms of some of these, the impact of regulatory scrutiny as we're talking about it, it's interesting. If you look at the data, you see that and this is information that we can get in terms of why banks are tightening their lending standards. Regulation is less of a concern in terms of regulatory policy, regulatory scrutiny. That's the side that we're looking at it from. It's less of a factor now. The bigger factors in tightening lending standards would be issues like their perception of the economic environment, their risk appetite, those types of issues, loan performance, their market strategy.
Well, in that area, when I have some of my regulated entities, my community banks come to me and say, our discussion about our buckets, I'm holding too much real estate, I need to roll to this, roll to that. So there's entire silos of what you might have used in that cross-collateralization that, boom, are gone, that you can't use. And doesn't that ultimately, in that mechanic, have the cascade effect of, don't come talk to us, I have no capacity?
I would just reiterate that, lending decisions and the decisions about portfolio composition are truly, these are bank decisions and bank management decisions. There is an influence from.
Are they truly a bank decision, or I know that you're on the Fed side, not the FDIC side, but that's in many ways a regulator decision.
There is some consideration of what the regulators, of the information the regulators give, and I think maybe from the banker side they can provide a little more insight on that. From what we see in the data, it just shows that regulatory policy is less of a factor in determining, the lending types of decisions. Now, in terms of, this idea of.
And I don't mean to cut. I'm
that's
over
okay.
time, but this is actually a really interesting discussion. At some point, I hope we can wrap to it, because I'm trying to mix what we get anecdotally with where we find actual data. So, thank you, Mr. Chairman, and sorry for going over time.
Thank you, Mr. Schweikert. Ms. Chu.
Thank you, Mr. Chair. Mr. Pharmakides, credit unions have expressed to the committee that the barriers to entry to participate in SBA lending are too great, and that's why very few credit unions opt to participate. Now, you have a most interesting history because you worked for the SBA, and yet you also represent the credit unions. So you've seen things from both sides of the fence. Other than what you've mentioned in your testimony about permanently exempting SBA loans from counting against the MBL cap, what else can we do to encourage credit union participation in SBA lending programs?
I think there's been bills presented before us today that basically are looking for ways to allow credit unions like ours to do more SBA lending. I think the key for that is changing the way SBA administers its program. The way that they've done it right now, the rules and the regulations to follow are very difficult and time-consuming, and quite honestly are just almost impossible to clearly manage the process without a full-time person in place. So a changing in the way that the program is administered. The other areas that we most definitely could hopefully spur more credit unions to getting involved is taking that SBA loan, the entire loan, and changing the cap so that way it does not go against a credit union's lending cap. If you were to free that counting against the lending cap, more credit unions would be encouraged to invest the time, effort, and staff cost in order to get into that program. And it is quite honestly a time-intensive and expensive way of doing business, one that credit unions can serve in, but right now the way that the laws are currently written, it's very preclusive.
And specifically in terms of reducing the level of expense to participate in the SBA program, like what specifically, what would be one suggestion that you would have?
There's a number of suggestions, but the one that I think to reduce the expense that we would want to have is lowering the cap and to just lifting the cap entirely, because then it frees us up to make those decisions across the board, both in commercial real estate finance, SBA lending, and then also working lines of credit, that in essence will allow us to do a better job managing our expenses against those type of loans.
I see. Ms. Weirsch, you stated in your testimony that one factor in reduced credit supply for small businesses is a decade-long shift in the financial industry away from this type of lending. In your opinion, what could we do to reverse this trend?
You know, the trend really, if you look at the data, you can go back even to the 1980s, where we had 17,000 banks in our country, and we're down to about 7,000 now. And most of that consolidation has taken place in the smallest category, the small community banks. And whether that trend can be reversed, I'm not sure I can say that I see any evidence that is likely or in any way possible. I'm sure it's possible, but there's just no signal that that's even something that could happen. And as I'm, hearing, the concerns about regulation and the pressure that puts on community banks, I would imagine that that's certainly a concern. We have not done any research to say that, there are different factors, forcing the regulation or the consolidation. Regulation, I imagine, is just one of many factors in that, but I don't see any indications that the trend is changing.
And in terms of reversing this trend, is there any kind of additional federal program that could fill the gap?
I have not looked at anything or seen anything in that regard.
Okay. Mr. Stibel, small businesses and startups are responsible for nearly 2/3 of net job creation. You mentioned in your testimony that there's a large discrepancy in access to capital across business size, where small and micro businesses face tougher lending standards. SBA has traditionally filled this void, but small dollar loans have steadily declined since 2007. What should be done to realign SBA's lending activity with its mission to provide access to capital to our nation's smallest businesses?
I think that's a great question, and one that speaks to the problem that Ms. Weirsch was alluding to, which is, we keep redefining the line and definition of what a small business actually is. And, before we can even have a cogent argument and discussion about what can be done, we got to figure out what the actual problem is. And, small businesses are the same size they were 100 years ago. They don't grow with inflation, right? A startup starts with 0 revenues and 0 employees, always. The problem is we've redefined the boundaries of what a small business is over and over and over again, on one hand. And on another, we've got different definitions. I'm sure if we asked everyone here, each one of us would have a different definition for what a small business is. And it'd be a good, strong definition. But without a singular definition, I think it's very hard to start addressing the problem. With regards to the smallest of businesses, the ones that are starting and the entrepreneurs and the true Main Street businesses, the core problem here is because those definitions keep growing, the government and banks keep shifting towards the larger businesses, and they ignore the current and present problem, which is most of our employment comes from the starting of businesses and their growth. And I think the first and foremost thing that the SBA can do is to take a leadership position here, define what it means to be a small business or a micro business or a startup, and then put a strong emphasis on lending to those companies and encourage that lending first and foremost. And don't focus on loan size. Don't focus on anything other than the size of a business from start to whatever the current definition of small is.
Thank you for that. Mr. LaPlanche, I found your suggestions on how to reduce the underwriting costs to be very interesting. And you are the CEO of Lending Club, and it's a credit platform that employs over 300 people in San Francisco. But could you describe how you implement your ideas in this credit platform, the Lending Club?
Yeah, so I can, I think I shared some of these ideas earlier, but I can expand on it. Certainly, looking at the $2 billion in loans that we've made this year, and these were mostly consumer loans. We've created what we call a credit review center. That's essentially a technology tool that aggregates data from 25 different data sources. And what's interesting is now with the internet, there are many new data sources that are created on an ongoing basis, and many new things you can learn about individuals or small businesses. In the case of individuals, there are privacy issues, there are FCRA issues. In the case of small businesses, with the authorization of the business, that helps us be more flexible and access more freely some of these data sources. So I mentioned Yelp ratings, Angie's List ratings. Many small businesses, Main Street businesses, whether it's a hair salon or restaurant, have a Facebook page. The number of likes on their Facebook page is an indicator of a trend in the business. The number of tweets and retweets, so in the activity on Twitter, is also an indicator of performance with the business. There are data sources that are not readily available but can be accessed through partnerships. So, for example, the ability to connect to UPS or FedEx and get shipping data about a business and have a sort of third-party validation of that shipping data and get that data sort of collected and analyzed automatically is another sort of indication of performance and a forward indicator of business activity. So there are all these data sources that are available either publicly or through partnerships with companies that service small businesses. That because we operate online in a way that utilizes technology, we can connect to and analyze quickly and incorporate in the decision. But then the other interesting things we do is the capital can come from many different data, very, very different sources, and we have partnerships with a number of banks. So now over 7 community banks are investors on the Lending Club platform and can sort of buy loans from Lending Club this way.
Thank you for that. And Mr. Green, as you know, one of the provisions of the Dodd-Frank Act, known as the Collins Amendment, increases the minimum capital requirements on large financial institutions while exempting banks holding companies with assets of $500 million or less. This encompasses the overwhelming majority of all community banks. Will this provision help to level the playing field and allow community banks to better compete with big banks?
I think, Congresswoman, when you look at all the regulation combined, you know what you mentioned on Dodd-Frank, and then you go back to Basel III. Basel III goes into the larger banks, but that'll ultimately come down to the smaller banks. There might be a window where the smaller institutions below $500 million, might have a slight advantage over the large ones as it relates to capital. But the general thought is that, like most other regulations, will continue to filter down and ultimately impact them, and that would change as well.
Okay, thank you. I yield back.
Thank you, Mrs. Chu. Mrs. Wiersch, you mentioned the decline in the number of small banks. And in your data at the Federal Reserve, do you know what's the primary source of capital for small businesses?
Well, in terms of where small businesses get funding, we have some information on this. We know from an NFIB comprehensive survey that 85% of small businesses identify a commercial bank as their primary financial institution. We can see, we can't, some of the information outside of the commercial bank area, we don't have a real good idea of who the borrower is. So we have limited information.
You mean the lender, right? You mean the lender, not the borrower.
I'm sorry. Well, no, who the borrower is. When you're looking at, like, if you're looking at aggregate numbers for finance companies and who we don't know often who they're lending to. We know total loan volume, for example.
But the NFIB says 85% of small businesses identify commercial banks as their primary source.
That is correct.
And would you say those would be large commercial banks or small commercial banks, or do you have any data on that?
There isn't any specific breakdown on that. Now, what I can tell you is that there has been a shift in where, among the commercial bank, in the commercial bank area, where small businesses are lending from. And that shift has taken it from a little over a decade ago. Small community banks comprised had a 51% market share of the small loan market, and that is completely shifted. So now the large banks have the largest share of the small loan market, and the community bank share has shrunk significantly.
Now, additional federal regulation, whether it be Dodd-Frank or any other federal regulation, increases compliance costs, correct?
Yes.
And so that just makes it more difficult to do business, correct?
I would say so.
So if we're saying that, you know, small banks are declining, that historically they've had over half of the small business loans, wouldn't it be logical to assume that additional federal regulation is one of the reasons why they're disappearing and small businesses are now moving to larger banks?
I don't have any research to definitively say that, but you know, certainly those are all factors in the trends that we're seeing.
Thank you, ma'am. Mr. Stibel, Stibel, I'll get it right eventually. You said something that was really interesting to me. My primary focus is jobs and American competitiveness, and I truly believe that competitiveness is measured in small degrees. You know, we're competing around the world. It's not major things. It's small degrees because everybody's trying to compete and everybody tries to do the best they can. And one of our primary advantages historically in America has been access to capital. You mentioned that small businesses don't have access to capital these days, and that they have increased revenue, but they're not adding jobs because they don't have access to capital. Is that correct?
That is, yes.
So can we translate that into this very much increased presence of the federal government in the banking system through Dodd-Frank as a reduction in jobs?
The cause and effect and in between, I think, is a bit hard to dissect and pinpoint on either a single piece of legislation or any type of regulation. Regulation can be good or bad, but I think it is causing pain points right now. And ultimately, without lending, you're not going to have job growth. As I said earlier, and you saw in that written testimony, we've now got some clear evidence that shows that that America's small businesses are getting back on their feet, but America's individuals, the employees, are not. And we're seeing this in payroll numbers. We're seeing this in revenue growth personally, so in terms of people's income, and then we're seeing this in terms of a lack of economic recovery on the job side, right? The jobless economy, and I think a lot of this does come down to the banking sector, and included in that is regulation, and we can do a lot more from that standpoint to free up that access to capital to the best businesses right now in our economy. And the irony is that's the smallest businesses. They're the hardest to determine. They're often the hardest to find when you see more and more banking consolidation. But they tend to be the best ones for sustained growth, for job growth. And ultimately, it's those small businesses that will become the next large businesses.
And so if Dodd-Frank makes it significantly more difficult to comply with regulatory burdens and small banks go out of business, then that's just that much less access to capital for small businesses, correct?
if we see more and more small community banks and alternative sources of lending either disappearing, those banks going out of business, or becoming more restrictive in terms of how they lend to small businesses, then absolutely we will see less capital flowing into small businesses, and ultimately we will see less job growth.
Mrs. Wiersch, Dodd-Frank was passed on the theory that we were trying to prevent what happened in the financial crisis from happening again and keeping financial institutions from becoming too big to fail, correct?
Yes.
All right, so in your opinion, does the regulatory burden under Dodd-Frank fall disproportionately on bigger banks or smaller banks?
I can't say. I mean, my research did not address that specifically.
Thank you, ma'am. Mr. Green, under Dodd-Frank, does the regulatory burden fall more disproportionately on larger banks or smaller banks?
Mr. Chairman, it does fall more disproportionately on the smaller banks and the larger banks. The cost, as I mentioned, is a fixed cost spread over smaller assets. The restrictive nature of some of the documentation, underwriting standards, all of those type things limit also the ability to make certain type loans.
Thank you, sir. Mr. LaPlanche, you mentioned something that was very interesting to me. You said that no underwriting process will ever be better than the relationship between a borrower and a community banker. And why is that, sir?
I think it comes back to the fourth C of credit and character. And I think especially for small businesses and for startups, there's just not a lot of data you can look at.
Okay, so it comes down to, I call it community banking or relationship banking. Hard to quantify and put in a file, correct?
That's right.
And the effect of the regulations under Dodd-Frank are to try to make every loan fit in this box, correct?
That's my understanding. I'm no expert in.
Well, so you take that discretion out. You eliminate that discretion, and the effect of that, in my opinion, is less lending to small business. Would that be a logical conclusion?
That seems to be a logical conclusion, yes. Mr.
Green, would you agree with that?
Yes, sir, I would.
Let's talk for a minute about the. So if we're taking the relationship banking off the table, who does that affect? Does that affect more large businesses that want to borrow with high income and plenty of assets, or does that affect more small businesses that want to borrow, startups and so forth?
It affects the smaller businesses. Again, the quality of the financial information for a smaller business is not as robust as a larger business, and as a result, you have to rely more on relationships, knowledge of that customer, their community, their competitors, things that are intangible for smaller businesses, smaller owners than you would larger businesses.
So we're penalizing small banks with this additional regulation under Dodd-Frank. We're penalizing small businesses with this additional information or regulation under Dodd-Frank. Mrs. Wiersch, where do most of the jobs come from, big businesses or large businesses?
If you're looking back to the 1970s, the highest net job creation rate is for among the smallest of businesses.
Thank you very much. Mr. Pharmakides, do y'all do mortgage loans?
We do, sir.
Are you familiar with these new qualified mortgage regulations?
I am, sir.
How's that going to affect your mortgage lending?
It's going to create some significant issues for us.
All right. Now, so if somebody comes in with high income and plenty of assets, is that going to affect the loan to them at all, these qualified mortgage rules?
No, it's not.
But somebody who comes in with a relationship with you guys that you may recognize that they might not have quite 41% loan to, or whatever that number is, income to loan ratio, but you feel like they're good for the loan and you otherwise would have made that loan in the past. Are you going to be able to do that now under this Dodd-Frank?
Under great difficulty.
It's going to be very difficult to do.
Non-qualified mortgage.
So it's going to make it harder for you to loan to moderate income, middle class people, but it's not going to affect the higher income people. Is that correct?
It's going to make it more difficult.
So we're penalizing small banks, we're penalizing small businesses, we're penalizing low and moderate income people, and we're preventing job creation. Other than that, this is a great law. Thank you. I'm going to defer. What's that? Okay. Mr. Payne?
Thank you, Mr. Chairman. And this is, I guess, a question any panelist could answer. You know, it's been stated today that there's a weaker demand for credit as an issue in most of your testimony. Should we expect this demand to return to pre-recession levels, or accept weak credit demand and credit alternatives as the new norm or the new trend?
I'll start out. I think the weakness or let me back up, the uncertainty in the economy limits the small business or makes them less, they're more hesitant to invest in capital goods to expand because the future is less certain. As a result, that's created less demand. If there is more clarity about the future and elimination or reduction in uncertainty, I think you'll see greater expansion in the economy, greater capital expansion, greater job creation, which will lead to more loan demand.
I just going to give a slightly different picture here from a credit union perspective. We are, in the last year, seeing greater demand for smaller lines of credit. We're talking lines of credit under $250,000, more opportunity, but we're still not able to serve that. So we are seeing greater opportunity. In 2013, we've closed 13 loans, 10 of them to small businesses, 2 of which were startups, small working capital lines of credit that currently the market isn't providing that capital access, and because of the current caps that are in place, we're having a really hard time getting that money out there. So there's regulatory caps and that we would hope could be modified in order to allow us to make those type of loans.
Mm-hmm. And I would just add to the distinction between those two last comments and say I actually believe that the demand is there. And we're seeing that with the surveys that we're doing to these small businesses out there. It's more the desire that's lacking right now. Part of that is certainly uncertainty. A big part of that's frustration, whether it's regulatory, whether it's just the banks turning businesses down throughout the recession. But the demand is absolutely there. And once businesses become more comfortable that the loans are available, you will see lending improve.
Okay. And yes, sir.
If I might add, I think that's absolutely right. And the supply and demand are very tightly intertwined. This survey from the Federal Reserve Bank of New York shows that, again, out of 70 small business owners who wanted capital, 29 did not even apply. So there's a self-selection out of the process for many small business owners. So when they feel supply of capital will be there, I think we'll see demand come back.
Okay, and Ms. Warsh, I'm sorry. In your testimony, you point out the fact that more lending is secured by collateral now than before the Great Recession. Do you think reversing this trend would be beneficial for small business? And what could we do in our capacity in Congress to help support that?
That's an interesting question. Looking at the shift in data, we do see that more banks are requiring collateral. I'm not sure that there's a policy solution to alter, the way that banks are making their lending decisions and setting the terms of their lending. But it's important to note that, as property values rise, that will help the collateral side of things, so borrowers can meet bank lending standards.
Okay, thank you. I yield back, sir.
Mr. Millay, you have anything? Mr. Chu? Okay, well, I just have one more question, and that is, what, if anything, just one thing, would you guys suggest that the federal government could do to improve the small business lending situation? Ms. Weirson, I'm going to start with you, and I'm going to go down the line.
Of course, our research did not attempt to make any policy recommendations. The one issue I would like to reiterate is that this is really a complex issue. There are a lot of factors at play, and any policy action should consider all of these factors. And addressing just one factor is unlikely to really move the needle on this problem, as you know, there are so many things happening here.
Mr. Stibel?
I think it's as simple as defining what a small business is. If I had one thing that I would recommend doing, start there. And I think
so. This is for SBA lending, is what you're talking about.
I would love to see it across the board. I mean, there's a bill right now on the floor for small business access to capital, where they're talking about certain businesses' funds being upwards of $150 million in size. It puts our business in the small business category. So I think it's critically important to do that broadly and to make sure that that's disseminated not just through the SBA, but through to the IRS when they're looking at small business tax credits, through to banks, both community and large banks, and through alternative lending sources.
Thank you, sir.
Welcome.
Mr. LaPlanche?
So I'll focus on the data accessibility part of that equation, because we use so much data as part of the underwriting. If the government could make more data more readily available to lenders, I think that would help the underwriting decision. So we've had discussions with the Treasury on better access to IRS data and the ability with the business owner to sort of easily access tax filings so that we can incorporate this data into the lending decision. That's one area where the government can help.
Thank you, sir. Mr. Green?
Thank you. I think, Congressman, Mr. Chairman, the mountain of regulations that have been levied on the banking industry has had the unintended consequence of hurting most, if not all, of the community banks. I would hope that Congress would maybe go back and look at some of those regulations to see if there is a disparity between what was originally intended and what's actually happened. Maybe modify some of those, certainly going forward, those that are in the works, to make sure that that does not continue. I will add that maybe in closing comments that there's a tremendous amount of capacity within the banking industry to lend to small businesses. The capital levels are the highest they've ever been. Liquidity is there. Competition is strong. There non-bank competitors like the credit unions, Pharm Credit, others. I know the gentleman to my right has mentioned in the cap in our state, the credit union that the percentage of assets percentage of business loans relative to assets at the highest level is below 5%, so they have tremendous capacity as well. In fact, I think nationally less than 1% of the credit unions are at or near that peak. So there's tremendous capacity in the banks, Pharm Credit system, existing significant capacity with the credit unions and alternative lenders. So if we could find a way again to eliminate or reduce those unfavorable negative consequences, that'd be very helpful.
Thank you, sir. Mr. Pharmakides?
The one thing for us would be to remove the member business lending cap and reintroduce the Credit Union Small Business Lending Act from the 112th Congress, which directs the SBA administrator to establish programs for credit unions. I think that would be very beneficial for us.
Thank you. Ms. Chu? Yeah.
Yeah, if I could ask a follow-up question. Mr. Stibel, why is the SBA definition of small business not adequate?
For a couple of reasons. Number one, there is no single definition. So the definitions right now are by category. And number two, and this is probably the most important thing, no one else is using it. And that's the real reason. What you need is a centralized definition that Bank of America is using, that Wells Fargo is using, that Lending Club is using, that we're using, so that we can actually have a proper dialogue about what a small business is. So it's less about what the definition is. It's more about making sure that everyone follows that definition.
I just want to thank all you witnesses for being here today. Your testimony's been very enlightening. Thank you very much for putting up with me, and this hearing is adjourned.